Welcome to the first financial markets report for Hodges Real Estate. I'm Tom Elliott. Now first up, there was a bit of good news in the budget. Stamp duty cuts for first home buyers have been put in place. They start at 20% next year, rising to 50% by 2014. Secondly, for investors in rural property, you will see a complete abolition of stamp duty for all farmers under the age of 35. Overall, though, it's got to be said that the Baillieu government will depend heavily on property taxes to maintain its revenue. As a result, I don't think we're going to see any major cuts to either stamp duty or land tax in the immediate future. Immigration has a very significant impact on the local property market. This comes essentially from three distinct sources. Firstly, skilled migrants to Australia want and get good quality housing, and their impact on residential sales over the past few years has been substantial. Secondly, returning expats are another source of demand for residential property. These are frequently people who have made a great deal of money in global financial centres like London and New York. They come back to Australia and they want to buy high quality top-end housing. Thirdly, the overall level of immigration does have a substantial impact on the overall property market in general. Unfortunately for first home buyers and property investors, I think there's a very high likelihood that interest rates will rise between now and the end of the year. I think the total size of the rise will either be only 25 or 50 basis points, but that is enough of an increase if it occurs to have a reasonable impact on people's buying ability. The reason I think interest rates are going to go up is this. The last federal budget said that inflationary pressures in the Australian economy were not being contained very well. The Reserve Bank shares this scepticism about inflation, so unfortunately I think you need to lock in rates at 25 to 50 basis points above where they are right now. The impact of the strong Australian dollar, if it remains at these levels, cannot be underestimated. People buying Australian property in any overseas currency, their purchasing power has depreciated by 15, 20, in some cases 25% in less than 1 year. How long will the Australian dollar remain well above parity with the US? My prediction is that after June, America will begin raising interest rates again. And at this point, I expect that the A-dollar is a reasonable chance of falling again versus its US counterpart. Recently, financial markets, and in particular stock markets, have been characterised by volatility, and I don't expect this to stop over the next month. We've got all sorts of impacts hitting the markets. For example, we could have more natural disasters, although of course such things are impossible to predict. We've got consumer spending on the wane over here and overseas, which is very bad for retail stocks. We've got the prospect of higher interest rates, which is very bad for the financial sector. And of course the resources sector, which is so very important for the Australian stock market, needs commodity prices to stay high. And in the last few weeks, they've been falling. The issue of whether to fix a home loan and by how much is a very vexed one for both property buyers and property investors. History will tell you that you should fix a home loan when fear is at its peak. I think whenever fixed rates go below 6%, it makes sense to lock them in for a decent time, 3 to 5 years being the usual time period that's popular. Even though I think interest rates will go up a bit over the next 6 months, I'm not sure it makes a great deal of sense to lock in rates right now, because fixed rates are already pricing in at least a 25 basis point increase. Thanks very much for watching this report. Hope you've enjoyed it, and I'll look forward to your company again next month.